Welcome back to the Deep Dive. Today we're tackling a really big financial goal based on these sources you brought in, generating $5,000 every single month.
Yeah, 5,000 a month. That's 60 grand a year, right around the median income here in the US.
And the aim is to get this purely from investment dividends, specifically from index funds, without ever selling stock.
Exactly. And here's the really counterintuitive part from these sources. They claim you don't need millions to start this journey.
Right. Most people hear $60,000 a year from dividends and immediately think seven figures. Easy.
But the strategy here suggests you only need about $1,000 to actually, kick things off.
Okay, that huge difference in scale is why we need this deep dive. We're going into the details from sources that lay out a specific portfolio focused on Fidelity funds.
Yeah.
So our mission today, uncover the exact strategy, pinpoint the biggest mistakes people make chasing dividends, and list the specific funds they recommend.
We're really talking about the difference between just saving money and actively building an income engine. It's a different mindset.
All right, let's jump right in. Why even focus on index funds? They seem, well, kind of boring compared to other ways people think about building wealth.
That's a fair question. I mean, you hear about real estate, right? Flipping houses, rental property.
We're picking the next big stock. That seems more exciting.
It does, but think about the reality. Real estate, it usually needs a huge down payment, big capital up front, and then you're not just an investor.
You're a landlord.
Exactly. Dealing with tenants, repairs at midnight, maybe paying a manager, which eats into your profits. It's basically a second job, not passive income.
Okay, point taken. And stock picking.
Yeah.
Fun, maybe, until one bad earnings report tanks your pick. High stress.
Definitely high stress. And the sources also mention newer things like crypto, kind of like a roller coaster with no seatbelt. Thrilling, sure, but incredibly volatile.
So the argument for index funds is?
It's about simplicity and reliability, mostly. Index funds are low cost, they give you instant diversification, you own tiny pieces of hundreds, sometimes thousands of companies.
So you spread the risk automatically.
Right. And the strategy is fundamentally simple. Buy, hold, and let time and the market do the work. It's designed to build wealth reliably, almost passively, while you focus on other things.
So the appeal isn't the thrill, it's the predictability. Less hands-on effort.
Precisely. You make some key decisions up front about which funds, then you let compounding take over. It's about automating wealth building.
Okay, that makes sense. This brings us to a major pitfall. The sources highlight the dividend trap. When people do focus on income from investments, what's the first instinct?
Find the highest yield possible, right? People immediately look for funds paying out, say, 7%, maybe even 10% right now.
More income now sounds better.
It sounds better, but that's the trap. A really high yield is often a red flag. It can signal that the market doesn't think the underlying company or assets can actually grow much.
Why else would the yield be so high relative to the price?
Exactly. The high dividend is often compensating investors for taking on more risk. Maybe the share price is stagnant or even falling. So the dividend is masking underlying weakness.
Ah, I see. So you get a nice check today, but the thing generating that check might be worth less tomorrow. You might lose more in principal than you gain in dividends.
That's the danger. And if the company gets into trouble, what's one of the first things they cut?
The dividend.
Right. And your income stream just vanishes.
Yeah.
That's why this strategy we're looking at shifts the focus away from just current yield. It emphasizes total return.
Okay, total return. Let's break that down. The sources mention three key parts.
Yes, this trio is crucial for building sustainable income. First, dividend yield. That's your starting income percentage. Needs to be decent, but not necessarily super high.
Okay, number one.
Second, share price appreciation. You still want the value of your investment itself to grow over time. That builds your base.
Makes sense.
And the third?
And third, arguably the most important for this strategy, dividend growth. This is the rate at which the actual payouts increase year after year.
Wait, hang on. If the starting yield is lower, say only 2.5%, why is the growth rate more important than just finding a 7% yield today? It's all about compounding. Think about it. That 7% yield, if it never grows, always pays you $7 on every $100 invested. But if you start at 2.5% and that dividend grows by, say, 15% per year, that initial $2.50 payment doubles roughly every 5 years. So after 10 years, it's $10. After 20 years, it's $40 from that same initial investment. It dramatically outpaces the stagnant high-yield fund over time.
So the dividend growth acts like a turbocharger for your future income.
Exactly. That's the engine part. It scales your income exponentially.
All right. If we need stability, diversification, and growth, the obvious question comes up. Why not just use the S&P 500? SPY, VOO, IVV, the big reliable index everyone knows, it grows.
That's a really important question to address, and the answer goes back to the goal. Is your goal maximum total wealth or maximum spendable income without selling?
Explain that difference.
The S&P 500 is a fantastic engine for overall wealth growth, primarily through share price appreciation, capital gains. But it's not really optimized for generating high income streams from dividends alone.
Okay, so let's look at the numbers you pulled from the sources. What does the S&P 500 typically deliver in terms of dividends?
Well, its price appreciation is great, historically around 10–11% a year, but its dividend yield is pretty low, usually averages around 1.27%.
1.27%. Okay.
And its dividend growth rate is okay, maybe around 6.4%, but not spectacular enough to rapidly boost that low starting yield for income purposes.
So if our goal is $60,000 a year, purely from dividends, and the S&P 500 only yields 1.27%, what kind of nest egg do we need?
Yeah, do the math. $60,000 divided by 0.0127, you'd need an initial investment of $4,724,490.
Wow. Okay. Nearly $4.7 million.
Exactly. And that number just puts it out of reach for most people aiming for retirement income solely from dividends using the S&P 500.
Which is why most standard retirement advice involves the 4% rule, right? Selling off shares over time to create income.
Precisely. You're forced to sell down your principal. That works, but it's not predictable, especially if the market drops right when you need the cash and you risk running out of money.
So the strategy we're exploring today is fundamentally different. It's about building an income stream that doesn't require selling the underlying assets. Keep the principal growing.
That's the core idea. Build an engine that pays you without eating itself.
Okay, so we need better yield than the S&P 500, strong share price growth, and crucially, much higher dividend growth. Let's look at the specific portfolio the sources constructed using Fidelity funds. Why these 5?
The idea is to blend different strengths to create, well, a high-performance income machine. It's about getting that dividend growth rate way up while maintaining diversification.
All right, walk us through them. What's the powerhouse in this mix?
The main driver for dividend growth seems to be the Fidelity Mid-Cap Index Fund, FSMDX. Mid-cap companies are often in that sweet spot where they're established enough to pay dividends but still growing fast enough to increase those dividends rapidly.
Makes sense. What are its numbers?
It has a respectable starting yield, around 2.27%, but the key is its 10-year dividend growth rate, a whopping 23.67%. That's huge.
23%. Okay, that's the turbocharger we talked about. What else? Diversification.
Yeah, for broader market exposure beyond just mid-caps, they add the Fidelity Zero Extended Market Index Fund, FZIPX. This covers smaller U.S. companies and adds a bit of international flavor.
And its contribution.
The yield is lower, about 1.19%, but it still contributes significantly to dividend growth, around 20%. So it broadens the base and adds growth potential.
Got it. Mid-cap for high growth, extended for breadth. What about stability?
Yeah.
Large companies.
Right, you need some ballast. That comes from the Fidelity Zero Large Cap Index Fund, FNALX. Think of your big, stable dividend payers. It offers solid appreciation, about 12%, and decent dividend growth, around 17%.
Okay. And there's another broad market one.
Yes, the Fidelity Zero Total Market Index Fund, FZROX. This seems aimed at capturing, well, overall aggressive growth across the entire U.S. market. It brings strong appreciation, 11.6%, and another dose of high dividend growth, 19.2%.
So that's 4 funds hitting different market segments, all focused on growth. What's the 5th one? The Sustainability Index.
The final piece is the Fidelity U.S. Sustainability Index Fund, FITLX. This adds an ESG screen, environmental, social governance. Often these companies are seen as higher quality, more resilient, maybe less prone to certain risks.
And its role in the income engine.
It provides a decent yield, 1.22%, and strong dividend growth, 18.07%, adding another layer of quality and potentially inflation resistance to the portfolio.
Okay, so you combine these 5. Mid-cap growth, broad market, large-cap stability, total market momentum, and ESG resilience. What are the combined vital signs of this portfolio?
When you blend them according to the source's suggestions, you engineer the numbers. The overall average dividend yield is about 1.36%, only slightly better than the S&P 500 initially.
Right.
But the critical number, the 10-year average dividend growth rate for the plan, is 19.62%. And you still get solid share price appreciation around 9.2% annually.
19.6% dividend growth. That's the game changer. That massive growth rate is what dramatically lowers the amount of capital needed compared to the S&P 500's $4.7 million requirement.
Exactly. It makes the $5,000 a month goal achievable through a different mechanism.
All right, let's get concrete. The sources lay out two paths using this specific five-fund portfolio and its metrics. Path 1 is for someone starting with less.
Yeah, scenario A, the slow and steady path. This is designed for someone thinking, I don't have much, but I can start now.
And the starting point is really low, just a $1,000 initial deposit, and then contributing only $30 a month. That's literally $1 a day.
Seems tiny, right? Most people would dismiss that as taking forever. But you have to watch the compounding effect of that high dividend growth over 30 years.
How does it play out?
Well, it starts slow. After 10 years, the portfolio is only worth about $9,183. Doesn't seem like much progress.
Okay.
But then the growth starts accelerating. By year 20, it jumps to $45,287. The engine is warming up.
And the 30-year mark.
By year 30, starting with just $1,000 and $30 a month, the portfolio value hits $441,188. And the crucial part, the annual dividend income thrown off is $79,729.
Wow. That's $6,644 per month, way over the $5,000 goal.
Way over. And get this. The sources calculate that of that final $441K value, almost $279,000 came purely from reinvested dividends compounding over time.
So the income engine literally funded most of its own growth. That's incredible. It really shows it's about consistency and time, not necessarily a huge starting sum.
Absolutely. Now, scenario B is the fast track, cutting a decade off that timeline.
Okay, so this requires more upfront commitment, I assume?
It does. Scenario B starts with a $20,000 initial deposit and then a more significant monthly contribution, $600, which is about $20 a day.
Right, a bigger commitment, aiming for the 5-kilomonth goal in 20 years instead of 30. What's the result?
After 20 years on this path, the portfolio value reaches $914,971, so nearly $1 million nest egg.
Almost $1 million in 20 years. Impressive. And the income?
The annual dividend income generated at that point is $68,698. That translates to $5,725 per month.
Goal achieved. 10 years sooner than the slow and steady path.
Exactly. And what's interesting here is if at year 20, the person decided, okay, I need the income now, and started taking those dividends instead of reinvesting them, they'd be getting that $5,725 monthly check, and their principal, the portfolio itself, would still be worth about $749,000. And that principal would likely continue to appreciate and grow the dividend further in subsequent years.
So it really demonstrates the concept, live off the income, don't touch the principal. The engine keeps running and potentially growing.
Yeah, I think the core lesson from analyzing these sources is pretty clear. If your primary goal is generating significant, reliable passive income without selling your assets, you really have to look past the immediate gratification of high yields.
That dividend trap again.
Right. You have to prioritize that total return trio, decent yield, yes, but strong appreciation and, most importantly, high dividend growth. We saw how focusing on a 19.6% growth rate versus the S&P's 6.4% changes the entire equation.
It's the difference between needing nearly $5 million and needing under $500,000 over the long haul based on these scenarios.
Exactly. It makes an ambitious goal seem much more attainable.
And the power here seems to be that it works whether you start small with $1,000 and $30 a month, or you go for the faster track. The key ingredient is patience and consistency.
Patience and letting that compounding engine do its work. Choose the right funds designed for income growth, set up your contributions, and then let time be your biggest ally. So maybe the final thought to leave listeners with is this. Imagine you successfully build an income machine like this, one that reliably covers your essential living expenses through dividends alone. You no longer need to sell assets to live. You're not constantly worried about preserving capital in the same way.
It's okay.
How does that financial security, that freedom from needing to liquidate, change how you approach everything else? What different career choices might you make? What personal risks or entrepreneurial ventures might you suddenly feel free to pursue, knowing your basic income foundation is solid and growing?
That's a powerful question. What becomes possible when selling assets is optional, not required? Something definitely worth thinking about.